What if the world is on the brink of another economic meltdown? Is history repeating itself with conditions eerily similar to the 2008 financial crisis? As central banks around the globe raise interest rates to combat inflation, the specter of a global recession looms large. The current economic climate is fraught with uncertainty. The World Bank has warned that even a moderate hit could push the global economy into a recession. Consumer confidence has dipped sharply, and we are witnessing the steepest slowdown since the 1970s. Interest rate hikes continue, but they seem insufficient to bring inflation down to pre-pandemic levels. Comparing these conditions with 2008, we see parallels. Then, as now, there was a housing bubble, high-risk lending, and an overvalued stock market. The 2008 financial crisis was a result of poor regulation, risky investments, and the bursting of the United States housing bubble, culminating in mortgage-backed securities tied to American real estate, as well as a vast amount of consumer debt. Today, we are witnessing a similar pattern with soaring asset prices and high consumer and corporate debt levels. The question remains, could these conditions trigger another stock market crash? Yet, there is a ray of hope. The labor market remains robust, with over 500,000 positions added in January alone, surpassing expectations. The unemployment rate has fallen to 3.4%, suggesting a recession may not be imminent. The World Bank suggests that policymakers should focus on boosting production and investment to combat inflation. Clear communication of policy decisions, credible medium-term fiscal plans, and targeted relief for vulnerable households could help central banks combat inflation without triggering a recession. In summary, the current economic landscape mirrors conditions leading up to the 2008 financial crisis. Central banks are raising interest rates to combat inflation, creating a potential for a global recession. However, with strong labor market numbers and targeted economic strategies, the downturn may be averted. Policymakers should focus on boosting production and investment, with clear communication and targeted relief for vulnerable households being key. The future of the global economy hangs in the balance, and the actions taken now will determine the course of the coming years.